Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. And in today's episode, I'll be covering how exactly to find compounding machines and invest like Warren Buffett. So this is on our Substack account. Feel free to check it out, link in the description box below. And in the first paragraph over here, it says, most retail investors, they overcomplicate their investment methods. They try and find small cap companies, momentum companies, companies that have gone up the most, and they neglect the most important thing, which is the fundamentals of the company. So what we do is slightly different. We find compounding machines. And as Warren Buffett says, a compounding machine is a company that is able to, number one, reinvest its earnings, and number two, at high rates of return. So what exactly does that mean? You can try and separate it out into two different metrics. One of it is called your reinvestment rate. The other one is your ROIC for the company. So ROIC times reinvestment rate actually equals to your growth in your NOPAT, which is your net operating profit after taxes. And if you have a company that is able to maintain high levels of ROIC and maintain high reinvestment rate, then you have a gem there that you really want to hold. So moving away from the equation, we'll be covering some of the qualitative aspects of your compounding machine. And the first qualitative aspect is a company that holds a significant market share in an industry where it is a monopoly or duopoly. The second qualitative factor that you want to look out for is a company that sells an essential product with pricing power with high switching costs. Because if this company sells one product and no other company is able to produce this, then all the customers will have to buy this product, and even if you increase the prices, they will still have to come to you. The third qualitative factor is a company that has strong fundamentals with organic streams of revenue. This is what we'll be covering later on. The fourth aspect, a compounding machine with growing revenue segments with recurring revenue streams. And the last one is you want to find a company with a management team that is wise with their capital allocation. In contrast, you don't want companies like this. You don't want companies that are operating in a highly competitive market. You don't want a company that sells a commoditized product because there's limited switching costs and hence limited pricing power. You don't want a company with stagnant fundamentals. And lastly, you don't want a management team that is always trying to push for mergers and acquisitions. So the first trait of a compounding machine is a company that is in a monopolistic position. So what you can think about is you can think of an industry as a pie, so a pie chart. And when you have more companies in the entire space, then what happens is you will have to split the pie up into different parts, into more segments. And what that also naturally means is that each company in that sector will have to take up lesser market share. So take, for example, a company like Delta Airlines. It's a company in your airline space in the US. The airlines industry growth in the US over the past 10 years has been quite significant. But Delta Airlines hasn't grown much. In fact, the fundamentals are stagnant because it is in an industry that is highly competitive, where there are many different alternatives in that space. So if you were to compare this to another company like, for example, Visa as well as MasterCard, these two companies are normally touted as duopolies. There are very minimal alternatives in the space, and what you will see over here is that it appears in their fundamentals also. So this is Visa's operating profit over the past 10-20 years, and it's just a straight line up to the top right hand corner. So the second trait for a compounding machine is a company that sells an essential product, allowing it to command meaningful pricing power and raising prices above the rate of inflation. So most companies in your S&P 500, they can't raise prices at levels above the inflation rate for the very long term. Most of them will regress to the inflation rate, but a small minority is able to do so. And these companies are the ones that sell an essential product, and these are also called your compounding machines. So pricing power is important because let's do a bit of math over here. Let's say a company sells a $100 product, and then let's say cost of goods sold is $50. Net profit is at $50. And then let's say this company raises their prices by 10%. So now it's at $110 and the cost of goods sold is still at $50. And what that means is the net profit actually went up to $60. Net profit increased by 20%, whereas your revenue or your prices only went up by 10%. So you really don't need meaningful revenue growth for a company with pricing power to have significant growth in terms of the net profits for the company. So a company can normally drive revenue through two different streams. They can drive it through volume increases as well as pricing ability. And pricing ability is the one that has the most effect on the net profits of a company. So take for example a company like Ford versus ASML. So next year, if let's say Ford increased their prices by 10%, then they will probably lose most of their customers. But if ASML does this, then ASML will still be able to maintain most of its customer base because it is an essential product. And this is ASML's pricing ability over the past 10 years. And as you can see here, it's quite meaningful. So they've increased the prices for these EUV machines by a CAGR of around 13% over the past 10 years. This is incredible growth for a company. The third trait is a company with strong fundamentals with organic streams of revenue. So what exactly is an organic stream of revenue? So organic streams of revenue refers to company revenue that is associated with the actual business of the company. So take for example, let's say if you have Microsoft, the organic stream of revenue will be from Microsoft 365 rather than from their investments elsewhere. So when you want to find companies, you need to find companies with organic streams of revenue, which is revenue that is from the core business of the company. So there are mainly two drivers for stock price growth. One of them is earnings growth and the other one is multiple expansion. In the short term, multiple expansion can drive up the stock price with more inflows into the stock price and more hype around it. But in the long term, history has shown that the main driver for stock price increase over time is earnings growth for the company. So a compounding machine with strong and growing fundamentals will almost certainly see a stock price increase over the very long time. Of course, unless you're buying it at an outrageous valuation. So when identifying quality companies, find companies with predictable, smooth earnings growth that go up towards the top right corner every year, and find companies that have organic streams, not companies that pursue mergers and acquisitions. Because if a company pursues mergers and acquisitions, like for example Salesforce, then you have a company there that is destroying shareholder value. So for example, Salesforce, they bought Slack a few years ago in 2020. They paid around $27 billion for it. And currently now in today's terms, it will be worth around $33 billion. That is around 15% market cap of Salesforce. And I'm sure most enterprises are still using Teams. They're not using Slack. They overpaid for Slack. And it hasn't been a good investment for the company. So mergers and acquisitions are unpredictable unless the company has a dedicated team of professionals like Constellation Software, like TransTime, that have been successful in doing so. Most companies fail in doing mergers and acquisitions. In fact, most mergers and acquisitions are failures from the buyer standpoint and winners in the seller standpoint. So when a company needs to chase for a merger and acquisition, what it means is that number one, the company has a weakening moat. So for example, Adobe with Figma. And number two, the company is chasing Wall Street estimates to try and beat those earnings estimates, like what United Health has done over the past few years. So contrast this to compounding machines. Compounding machines are companies that don't need to pursue mergers and acquisitions. They simply buy back the shares, they give out dividends, they don't use the capital that they have to pursue excessive mergers and acquisitions. Because when a company is doing so, what that means is that the company's moat is weakening. Fourth trait of a compounding machine is a company that has a recurring stream of revenue. So why exactly is a recurring stream so important? So take for example Adobe, Microsoft. These companies, they were previously under the one-time payment license model. And then after they switched over to the subscription model, their earnings took a hit for 1 year. And after that, it was smooth sailing all the way. So a recurring stream of revenue is certainty of cash flows. So they know how much they'll make next year, the following year, and so on, because there's a lock-in for this company in terms of cash flows. And then what it also means is that when an economic shock comes, these recurring revenue companies will still be able to have strong fundamentals during bad times. And besides that, it also increases something called your lifetime value of your customers. So lifetime value of customers refers to the total cumulative amount made from each customer over the lifetime usage of the products. So instead of them just paying one time, they have to pay every single year all the way till they stop using the product. So the last trait of a compounding machine is a company with a strong management team, a good management team, with sound capital allocation skills. So as we mentioned earlier, companies that pursue excessive mergers and acquisitions are commonly avoided unless they have a specialized team that is doing so. So instead of finding companies that pursue mergers and acquisitions, find companies that do the basics because they won't make a mistake in doing so. So companies that buy back shares, give out dividends, This is a bulletproof method for them to basically give back to their shareholders. So when a company is pursuing excessive mergers and acquisitions, that could be a possible telltale sign that the company is weakening and it's a consideration to exit the position. Next portion, I'll be doing a deeper level analysis. And before that, this is actually the most liked comment in the previous video. So it says, if your goal is really to buy compounding machines for the long term, I don't think you should sell Google or even trim it unless you need the money, but you seem to have a lot of cash. And then the follow-up comment was this: I understand your concerns, but I still wouldn't consider selling it unless it goes under a certain level, for instance, the 10-week SMA. So I'll be covering Google stock here, and this is what I wrote on the Substack account. So it says, let's start off with Google. Google is a company currently trading at 30 times of GAAP earnings, 35 times NOPAT, and one of the biggest AI winners in the space. The stock is up 100% from the lows in April and is touted as one of the best companies to own right now. So many online have said to not sell the company to hold on to a compounding machine, but there's actually a lot more nuance to it. So the problem is this: when the market is already pricing in all this, then the future expected return drops. When a company is trading at a higher valuation, let's say for Google now is trading at 35 times of earnings, then what that also means is that your future expected returns is lower. So one way to think about it is earnings yield plus growth. This was what I covered for Google in the previous video. So another thing to understand is this: a company only produces excess returns meaning bucket beating returns, if the company is able to beat expectations. So when you have Google already being touted as the biggest AI company in the world, a company that is currently trading at 35 times of earnings, the only way for this stock to go even higher is for them to beat earnings or to sustain the operations for the company for the very long term. And in tech as a whole, it's a very disruptive industry to be in. So 5 years ago, I'm sure no one expected whatever we're having today in terms of chatbots, in terms of AV. We don't know what is going to happen 5 years later. And most people underestimate the risk of disruption, and it applies for Google over here as well. So when a company has sky-high expectations, the only way for the company to produce excess returns is to beat that sky-high expectations, which is what Nvidia has been doing. But this is unsustainable in the long term. So this is an important concept that a lot of market participants fail to grasp. Holding on to a wonderful company might not be a wonderful investment unless the time horizon is limitless and unless there is certainty of the company being around and being strong for the duration of that time horizon. So the only way for Google to maintain this level of returns is for the company to, number one, beat expectations, and number two, be a quality company over the next 5 years at the very minimum. So certainty of cash flows is dependent on the business industry and the ability to fend off competition, and Google is currently facing disruptive threats from your LLMs. This is undeniable. So bringing back to compounding machines, find companies that can beat expectations for a sustained period of time with the ability to fend off competition, and you have found the company that will give you excess returns over the very long term. And for Google today, I think the company is amazing. I think the company is wonderful. But those people saying to not sell the company at all, this is another perspective that you might want to consider. Anyways, I hope you guys found this video useful. Feel free to check out our Substack and invest safe.